Hey everybody, Dave Bartosiak here, and we're going to talk about the anatomy of a reversal. So, what do you look for when the markets are bouncing or reversing? Now, you could use this for a top market, top heavy market when you look like it's going to roll over, or you could use it for a market that you're trying to look for that bottom, which is what we've seen, I believe. Yesterday, I wrote a Zacks Confidential piece that was on March 30th about how everything looked like it was starting to turn. And sure enough, here on Tuesday, March 31st, we're doing this at night here. It looks like everything has, in fact, turned. I'm not doing that to toot my own horn, but you could timestamp it. But I want to go through and look at kind of show what we're looking at, but look at some of the tools that we have on Zacks.com that can clue you in on that. So if you go to whatever your favorite quote page is, it doesn't matter. In this case, I just happen to have Apple handy. So here we are on Apple. And on the left side, you have all these different tabs you can click on. I use the interactive charts portfolio here. This gives you a little screen here, a little chart from our partners over at TradingView. And TradingView has their own thing that is a standalone service that I actually use on my own. It's fantastic, but there's so much power here in this chart they're giving us for free on Zacks.com. I just had to show it. So if you click on this little menu here, you can get yourself a pop-up, which is it's fantastic. So here we are on Apple. What I like to do, like to move to the candles rather than the bars. And then I have a little bit of a hack for you here. Rather than use just a simple moving average, I can use a moving average ribbon in this case. And the reason I do this is you're limited to how many indicators you can use in this sort of free version. So this is a quick little hack. And I put the RSI, the relative strength index. Now I can go on this moving average ribbon and click on the settings tool, and I can select what I want. So for me, I'm a 200-day and a 50-day guy. And for some reason, I like to make this blue. Maybe it's because I'm a Cubs fan. I don't know. But I like to make that 50-day moving average blue. So a couple of things that we want to look at. I think first and foremost is I'm going to look at crude oil. So this is West Texas Intermediate. This is the contract CL that you're going to see on the NYMEX. It's what we talk about the most often when we're here in the good old US of A. Here you can see that oil started a little bit of an uptick back in January to kick off the year, but things really didn't heat up until the first missiles were fired at the end of February, and that's when we went from trading in the mid 60s to nearly doubling in very short order as that Strait of Hormuz was closed, and now we're still in an overall uptrend. But if you notice here on March 31st, you have oil going from 106.86, dipping a toe into the double digits after some news that broke. And the news is really that the Iranian president said that Iran's looking for an end to the war, and that it's just all about what their demands are. So that little bit of talking point was enough to really help the market reverse. Now, there's a few indicators I'm going to get into. The first of which is we have the percent of stocks above the 200-day moving average. Now, this is a much longer term sort of overbought, oversold indicator. And when you're talking about a market that has trended so much, which is what we've seen obviously in our domestic stock market, you're going to have to choke up on the bat a little bit. So what I mean by that is you're going to have to use this one's sister, okay, which is the percent of stocks above the 50-day moving average. But I wanted to just show this at least that there's been a big move from January 22nd when 67% of stocks were trading above their 200-day moving average to recently when only about 42% of them were. Now, the great part about this tool is if you're looking for something, you just got to start typing it in plain English and it'll it'll pop up for you. So in this case, I was looking for the percent of stocks above the 20-day moving average. And here we go. You just start to type it and there you have it. Okay. So in this, something that I pointed out is back last week, March 20th, only 17% of stocks were above their 20-day moving average. So this is a really short-term sort of oscillating indicator that you can use for these little short-term pops. And if you notice, for the most part, it sort of bounces in between these 20s and 80s, 20s and 70s, 30s and 70s, right? So it gives you a general idea, and that is in a really short term. But during my Zacks Confidential piece, I focused on this 50-day moving average because it's an intermediate term average. You look at it as the last few months of action, 2.5 months or so. And when these levels start to get, under 20, under 30, they tend to reverse. So you saw that in November. You saw that a little bit more extreme. It got down to 5 in April of 2025. You have another little January move. You have the August 24 move. You have April 24 move. Okay, so just quick peek. Things were oversold at a broad scale, and you can use something like this to determine that. Then the Dow Jones Industrial Average. Now, it's not often that you're going to get oversold ratings or oversold readings rather on an RSI, on a daily RSI on the Dow. Last time you got it was back in April 2025. That certainly coincides with that other chart we were talking about, right? With the moving average, or the percent of stocks beneath their 50-day moving average, also reach extremes at that point. And as you go back to some of these, that's back in 2023, but April 24, that was another one. August 24, right? So you can use these sort of in conjunction. Now, the Dow underneath its 200-day moving average is not all that common. We had it in 2025 for a little bit when things got pretty bad. We had it 23. There have been some more extended moves like in 2022, and obviously the COVID lows that we bounced out of. But generally speaking, the 200-day moving average usually does a pretty good job of smoothing things over on these major market averages. And when you're talking about the mega caps of the Dow, there's one. So we've got oversold on the RSI beneath the 200-day and the 50-day moving average. Something's got to give, right? So the short term, at least, it looked like something was going to bounce. Now, how high this goes, we're not really all that sure, right? A retest of the 200-day, and then we get to see what happens. You have the 50-day that's rolling over with a negative slope. Not a good thing. We're going to get that dreaded, what they call the death cross coming up here, where that 50-day or that shorter term moving average crosses under that 200-day moving average. I suspect that's going to happen sometimes towards the end of April. But what I have noticed is oftentimes those death crosses actually mark the end of the downside run. Case in point, April 2025, that turned out to be sort of the end of things. And as you sort of just look back on the chart, you can just find times when that 50-day comes under and it doesn't, sometimes it's the end of it, right? Now, I don't want to sound like a Yogi Berra here, 50% of the time it works all the time. But in my experience, the death crosses have been less of a predictor than like a golden cross would be, right? Because stocks just tend to go up. The death knell doesn't always make the right sound, whereas when you have that opportunity to buy the dips, it usually turns out a little bit better. So there's the Dow, right? You got oversold. What's going on? The NASDAQ Composite Index here. Well, let's just do the Qs rather. If you look at the Qs, the NASDAQ 100, you can see that again, you have the double top into January, and then the retracement. You've got oversold on the RSI on a daily chart. Last time you had that, again, April. So another trick that you can use here using these charts is using a fib retracement. So what you do is you take the low, like a recent low, bring it over to a recent high, and it'll automatically draw these levels for you of areas of potential support. Now on the NASDAQ 100, it didn't quite get to that 38.2% retracement level, which is something I would have felt better, to be honest. Another day of selling would have done it some good, I think, from a technical standpoint, but it just never came. But still, you got the oversold in the RSI. You've got these moving averages cascading lower. But then we've got this big candle here on Tuesday, the 31st. So things starting to move in the right direction, at least when you're talking about that. The other thing we're going to look at here is SPY, which is basically the S&P 500. And we're going to draw one of those fibs again from the lows in April to the all-time highs. And here you'll note how the 23.6% retracement gave a little bounce. We dipped under. Now we're back above. Again, I would like to see a little deeper retracement. That doesn't mean that we don't get it. But in the short term, we got oversold RSI in the daily. Same thing that we saw in April. So it looks like right now, at least in the very short term, we're getting a little bit of a bounce. Now, the small caps of the Russell 2000 here using IWM as proxy, this has been a little bit more of a cleaner textbook move in that the 200-day was tested yesterday, kind of failed at it, but now we get a rally up above it where we opened at it and move higher. Certainly not out of the woods yet on the small caps, not by any means. A little bounce here, but you mean you took out the Friday highs, but really until we get through this 253.07 level on IWM, you can't really say that this downward trend channel has been broken. But as long as this rhetoric gets a little bit better, I think that markets can continue to sort of bounce. So what do you look for in these? We look for a move down to support, which we've seen. That support can either be a major moving average, in this case a 200-day, or it could be these fib levels. And you can go ahead and draw another fib level here on the Russell, and you can see that 23.6 sort of came into play, but we didn't get that deeper move to the 38.2. So I'm cautiously optimistic here looking at these. Now, if the market really starts to continue with the risk on, it's going to be these tech stocks. I think they're going to lead the way. So I'm looking at stocks like Meta, which are nearly back at April 2025 lows, which is crazy to think about when you see some of these numbers. But Meta's move from that big spike up 744 back at the end of January, and then yesterday we're trading in 520s. Pretty dramatic move in a very short period of time to get back down to lows that you haven't seen since the market was really under some pressure. So it's going to be interesting to see how stocks like these bounce a little bit. Another one I want to point out, which was a recent darling, is Micron. Now we have Micron as a Zacks rank number one strong buy right now because estimates just keep moving in one direction. And here you have from mid-March, really just 2 weeks ago, the stock going from 471 down to 311 earlier today. Now granted, it was 270 or even if you go back to April of 25, you're 67, right? So yes, it's had a really big run. Now I want to touch up on one of these hyperscalers, Nebius Group. This one's been one of the strongest. And as you see, the 200-day moving average here still provides support. Now, given the context and the backdrop of what you saw with the rest of the market, with everything selling off and everything dumping and everything coming under pressure, the fact that a stock like this was able to stay in there, given that huge move that it already had, is pretty impressive. Now, granted, it has gone from 130 down to 89 in pretty short order. But if it moves that quickly to the downside, it can get back up just as quickly. All-time highs on this are 140, 110. That was back in October of 25. So what we've been telling everybody is get your shopping list, check it twice, and continue to look for those Zacks ranked #1 strong buy stocks on Zacks.com. And for now, at least, we're not afraid to get a little bit more aggressive. All right, folks, that's all I have for you today. Thanks a lot.